Ladies and gentlemen, good day and welcome to KSH International Limited Q2 and FY26 earnings conference call hosted by Nuvama Institutional Equities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Archit Joshi from Nuvama Institutional Equities. Thank you, and over to you, Mr. Joshi.
Hi, thank you. Good morning, everyone. On behalf of Nuvama Institutional Equities, I welcome you all to the 2Q FY26 earnings conference call of KSH International. We thank the management for letting us host their Concall. We have with us today Mr. Rajesh Hegde, Managing Director, Mr. Amod Joshi, Chief Financial Officer, Mr. Dhruv Chopra, Head of Investor Relations, and Mr. Nakul Patil, Head Secretarial. Without further ado, I'd like to hand over the call to Mr. Rajesh Hegde for his opening remarks, post which we can have a Q&A session. Over to you, sir. Thank you.
Yeah, thanks, Archit, and good morning, and wish you all a very happy new year. I would like to welcome all current and prospective shareholders to the KSH's debut earnings call for the second quarter and the first half of fiscal 2026. I want to once again acknowledge our board, our team, our investors, and all our advisors for their support and the pivotal role they played in getting us to this point. From here on, the onus now shifts to the company to set the strategy that will deliver long-term profitable growth, and as importantly, to execute said strategy, in turn generating long-term value for all our stakeholders. Our second quarter and first half financial results, along with supporting information, have been submitted to the exchanges and uploaded to our website last evening. However, given that this is our first earnings call, I would like to spend a few minutes outlining who we are, how we are placed, and where we go from here. We will then provide an update of the second quarter financial and operational highlights, as well as the recent developments before opening up the call for questions. KSH International is a 45-year-old manufacturer of magnet winding wires, which is the most critical component of coils used in large and small electric machines. From power transformers down to the smallest compressors for AC and refrigeration and everything in between, this is where the coils are used. We are the third largest winding wire manufacturer in India, with an installed capacity of 41,045 metric tons annual capacity, and we are also the largest exporter of winding wires from India. Once phase 2 of our Supa expansion is completed in FY27, we would have an installed capacity of 59,045 metric tons in place. We are a B2B company servicing approximately 120 leading domestic and global OEM customers, and maintain long-term relations with these customers, resulting in more than 90% of our revenue being from repeat customers. In fact, 5 of our top 10 customers have been with us for more than 10 years, and the oldest for close to almost 40 years. Our track record with our customers is our biggest asset. Additionally, our business is make to order, which means that we procure the copper and begin processing only after receiving a purchase order from the customer. Thus, LME copper prices and exchange rate is a direct pass-through for us, and we do not take any exposure to short or long-term variations in the copper price. Roughly 75% of our revenue comes from large power transformers and medium power transformers used in generation, transmission, and distribution, in renewables, railways, and in data centers, driven by a core product which is continuously transposed conductors, or CTC. This product, which we are the market leaders in India. CTC is a complex engineered wire product that goes through 5 or 6 precision technology steps and fault minimization processes to arrive at the finished product. Unlike standard or round wires, which is essentially a 2-step process. Additionally, all of our exports is exclusively to transformer companies across 24 countries. A few incremental points I would like to highlight about CTC specifically are that we are one of the first companies to introduce and scale CTC in India almost 20 years ago as an import substitute and have maintained our leadership in this product ever since. In addition, given our successful track record, we are approved for all classes of power transformers, including being the only Indian company approved to supply to HVDC 400 kV transformers. CTC is what differentiates us from all our listed peers and accounts for more than half of our specialized winding wire business. Why do we succeed? In an ultra-precision field, our long-term mantra has been that quality has to be built into everything we produce, not something that gets inspected at the end. This results in the quality and longevity of this product, most of which is still actively working out there in the field. Coming back to the T&D sector, it is experiencing a structural long-term cycle driven by renewable energy, grid modernization, urbanization, and growing power demand for AI data centers. This is not just an India phenomena, but it's a global one as well. The primary bottleneck is the supply of power, medium, as well as distribution transformers, which is driving capacity expansion by transformer manufacturers globally. But without high-quality winding wires, the transformer is just a sophisticated box. This is a demand environment in which we operate, and the reason why we began our capacity expansion efforts 2 years ago. One of the key barriers to entry in our business is approvals from OEM customers as well as utilities, and we have approvals not only in India but in each of the countries that we service. From inception, we have always been a manufacturer of specialized winding wires, which are used in transformers, railways, EV traction motors, wind generators, etc. And it was only really in FY22 that we expanded into standard or round wires to focus on specific applications such as compressors for ACs and refrigerators and EV traction motors for two-wheelers. Our focus on power transformer benefits from the robust demand for the foreseeable future, given substantial increases in local as well as global power generation, irrespective of whether it is traditional or renewable. This is the further validation by publicly announced strong order backlogs and a capacity expansion plan by all of our core customers, be it BHEL, CG Power, Hitachi Energy, GE Vernova, Bharat Bijlee, Siemens, Toshiba, or any other such transformer manufacturer. Longer term, our investments in the specialized magnet winding wire for EV motors and certain types of standard wires should help us create a more diversified and balanced portfolio with sustainable growth and profitability. Shifting to exports for a minute, we have historically managed export contributions between 30 to 40% of our total revenue. In FY25, this contribution was consciously brought down closer to 30%, given our capacity constraints and certain high-value opportunities in India. Now that our larger capacity is in place, we can address both the demand both in India as well as abroad. In summary, our key strategies to drive sustained growth is to grow volume from higher value-added segments like T&D, EV motors, etc., and exports. Then expand our international presence, including expansion with our global clients. Then also to increase wallet share with existing customers and drive operating efficiencies through scale and backward integration. And lastly, to of course improve our sustainability efforts. Let me now turn to execution and our second quarter and first half FY2026 performance. We are delighted to report a record second quarter in our 45-year history across all key metrics. This performance not only sustains our first quarter trajectory, but in fact improves on it, continuing our growth and profitability leadership amongst the listed peers in our industry. During the second quarter of FY26, our revenue from operations of rupees 712 crores increased 50.7% compared to the same period last year. Specialized winding wires represented approximately 77% of our total revenue, excluding other operating revenue during second quarter of FY26. Revenue from exports grew 21.7% compared to Q2 of FY25 and represented 29.5% of the total revenue, excluding other operating revenue during the period. Second quarter FY26 EBITDA of rupees 46.1 crores improved 74.2% year over year. EBITDA margin and in Q2 of FY26 increased to approximately 6.5%, up approximately 90 basis points from last year. As we have stated, reported margin can fluctuate due to the movements in copper price, given that copper is a pass-through. It is reflected in the revenue but also in the cost of sales. Therefore, to evaluate the underlying progress of the company's profitability, it is more important to look at the unit economics of the business, which is EBITDA per ton. Thus, for second quarter of FY26, our EBITDA per ton was approximately 65,500 rupees per metric ton on a consolidated basis and increased to 42.1% from roughly rupees 46,000 per metric ton last year. This improvement was driven predominantly by growing volumes of CTC and within that towards our focus towards higher voltage transformers, higher export volumes, better utilizations and fixed cost absorption. During Q2 of FY26, we reported PAT of rupees 29.6 crores, up 128.9% from rupees 12.9 crores in Q2 of FY25 and up 30.5% from Q1 of FY26. PAT margin during the quarter was 4.1% compared to 2.7% a year ago, showing approximately a 140 basis point improvement. Diluted EPS for the Q2 FY26 was rupees 5.2 per share, growing 128.8% over the prior year. I would now like Amod Joshi, our CFO, to go over some of the details on the IPO proceeds. Over to you, Amod.
Yeah, thank you, Rajesh. Very good morning to everybody. I would like to wish everybody a happy new year. Coming back to the IPO proceeds, if everyone recalls, the company had raised 420 crores in fresh issue proceeds from the IPO, which had two primary uses, excluding the general corporate purpose. The first was rupees 226 crores towards repayment of long-term and short-term debt. I am pleased to let you know that the company has already paid rupees 225.9 crores towards reducing its term debt as well as certain working capital lines. The benefit of this will become visible going forward. Repayment of this debt also further enhances the balance sheet and the financial position of our company, thus allowing us to focus on our growth and further establish our leadership position in key end-use industries such as T&D and EV motors. Now, the second primary use of the fresh proceeds was rupees 97 crores, which was towards capital expenditure in Supa and Chakan plants, as well as installation of the rooftop solar power plant at Supa. Now, orders and advances for some of the machines have already been put in place, and we expect deliveries of this equipment to happen over the course of the next 15 months. Now, given the current demand and environment in the T&D sector, our endeavor is to ramp up the CTC capacity as quickly as possible and bring some of the standard and EV wire machines over the course of FY27. Once completed, we would have more than doubled our capacity from 29,000 metric ton to 59,000 metric ton. Now, with that, I'd like to hand over the call back to the moderator to open up for questions, please.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Nidhi Shah with ICICI Securities. Please go ahead.
Hi, thank you so much for giving me the opportunity to ask questions. My first question would be whether you could provide us with the breakup of specialized and standard wires in terms of volumes, and what has driven this growth in volume we're seeing YOY.
Specialized and standard winding wires?
Yeah.
Yes.
So,
revenue is 77%.
yeah, so revenue from specialized is around 77% of the total sales in Q2 of FY26. And the growth was specialized between the two quarters has been almost 20% on the specialized front. And almost 20% on the specialized front. Yeah.
So this means you mentioned that this is volumes, right? The volume growth.
Yes.
Okay. And what has driven this volume growth, and how much of the current volumes in specialized comes from power T&D?
Yeah. So, almost, when you look at the specialized, almost everything comes from the power T&D, wind generator, and railways is what we talk about, So it's not just the power T&D, it's also the transformers that go into the railways. So that basically comprises of the specialized winding wires that we manufacture.
All right. Also, in the press release, you mentioned that the company has exclusive licensing of HPW's peak wires. Could you provide us with some details on what capacity are we looking to build here? What is the current competitive landscape within the country where peak wires is concerned? And could you walk us through the rationale of licensing? As I understand, all the products that we do currently have in our portfolio are not licensed. So what has led to this decision? And overall, just giving us some understanding of what could be the revenue potential of this segment.
Okay, so, in India, basically the current landscape for traction motors is up to 400 volt capacity. And if you see globally, what's happening is, the shift is happening from 400 to 800 as the vehicle sizes become larger. And globally, what's happening is when you shift to 800 volts because of faster charging, etc., then the peak wires are generally used by these manufacturers of traction motors. Why we have gone with HPW is that HPW is one of the two manufacturers with patented technology for peak wires, and they have a global patent as well. And what we are trying to do is we are trying to indigenize this technology. We have taken up a license because this is a patent technology, and we'll use this technology and set up lines for indigenizing this product to be supplied to the local manufacturers here of traction motors. Now, keep in mind that this is more of a future, we are investing a little bit early in our cycle, but this will not have an immediate, impact, but, we'll be working on programs with some of the manufacturers for EV motors, and that's where the real benefit will come maybe, after FY27 is when we expect,
All right. So from what you're saying, I understand that currently peak wires are not really being used in India. Is that a correct inference?
Yeah. So currently, India is not available because these two manufacturers are based out of Europe. But there are traction motor manufacturers who are setting up capacity to manufacture traction motors for the 800 volt and above segment. So this is more, it's a work in progress is what I would like to tell you. And we need this capacity right now because, you take part in the program, and once the program matures, then that's where we would see a meaningful volume going forward.
Okay. Thank you so much. I'll get back in the queue for further questions.
Sure. Thanks a lot, Nidhi.
Thank you. Next question comes from the line of Kushal Kasliwal with Invert Research. Please go ahead.
Yeah, hi. Thanks for the opportunity. Thanks for, briefly introducing in detail. Sir, my first question was around your EBITDA per ton, which seems to be, significantly higher than some of the other, listed peers. So any particular reason why you see a higher EBITDA per ton? I mean, almost everyone also manufactures CTC, and most of our products are also being manufactured by those peers, but our EBITDA per ton seems to be higher. So any particular reason for that?
Yeah. So if you compare us to our peers, we would, out of the total capacity, almost 75% of our business is actually specialized winding wires. Whereas if you compare some of the other peers, they would be exactly reverse, or maybe focused only on the standard magnet winding wires. Although it comes within the magnet winding wire basket. But when you look at in terms of profitability, specialized winding wire is a much higher profitability product as well. And the reason why we are more, have a higher EBITDA per ton is within transformers. Also, we are focusing on the 765 kV and the HVDC segments and the large power transformer segments, which are more complex and of higher value addition in nature. As well as, our focus is also there on exports, where, almost about 30% of our production we export, where export gives you a slightly better margin as compared to the local manufacturers, And when you look at the large power, CTC for the large power transformers, especially as you keep going up, towards the 765 kV segment, you have fewer manufacturers who are approved for the 765 kV or the HVDC transformer segments. So that kind of gives us it might look that there are many players, but there are few players right on the top actually.
So maybe just a follow-up on that, sir. One of the large company, transformer rectifiers, which is a higher kV transformer manufacturer, they are actually backward integrating into CTC, which seems to be our main product in specialized winding wires. So any risks with these large players only getting into backward integration, and then apart from these large players, I mean, how many other customers are there who are not backward integrating, or maybe let's say in 2 or 3 years who will probably be a market for us?
Yeah, I mean, so transformers and rectifiers, we've heard that they are also backward integrating. But I mean, you keep in mind that, these are all continuous processes again, and these run 24/7. And for, manufacturers to really backward integrate, they need that kind of volume also. And we have not seen this trend anywhere else. In fact, anywhere else in the world that we have seen, most of the transformer manufacturers are not doing, and there is a certain degree of complexity also that is involved in manufacturing CTC. And that's why we don't see this as a risk coming up in future,
Got it, sir. My last question was on working capital. It seems like due to some lower payable days, our working capital is a bit higher versus some of our peers, which, with the kind of growth you are seeing, that increased working capital is not allowing us to have a positive cash flow on the cash flow statement. So any comments around it? How should we look, let's say 2 to 3 years from here? Will we be able to generate some positive CFO in the cash flow statement?
Yeah. So rightly pointed out, our working capital days are around 75 days, and as compared to peers a little more. We are actively engaging and undertaking steps to bring down the working capital days consistently in the next 1 or 2 days at all fronts, may it be receivable days, inventory days, or increasing the payable days. And we hope to, achieve some sort of positive results in the next, 1 or 2 years on that front.
Hi, this is Dhruv. Just to add one point on this, if you look at a 10-year history, generally most of the years we have generated positive operating cash flows. It's only in the years where growth has been north of 30-35%. But again, going forward, our endeavor is to try and reduce those working capital days so that we can sustain cash flows even during high growth periods.
Got it. Thank you so much for answering my question. Thanks.
Thank you. Next question comes from the line of Mahesh Bendre with LIC Mutual Funds. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Sir, the expanded facility, new facility at Supa, I think has come up on stream now. So will that add a substantial volume in the current quarter and next quarter?
Yeah. So the Supa facility, is available. The 12,000 tons, which was completed in phase 1, that capacity is actually available from 1st of October onwards. And it will be available till the end of this year, a financial year. And definitely, this capacity, we intend to use it to service the market. That's why, our capacity has gone up from 29,000 to 41,000 tons.
So, has that capacity stabilized or is it still in a ramp-up phase?
Yeah. So typically, see, in our industry, 85% capacity utilization is a good indicator in terms of capacity utilization. Now, any new plant that is there, it takes about, say, 2 to 3 years to reach that 85% peak capacity utilization. Now, having said that, this plant is already operational, and we have started utilizing this 1,000 tons per month capacity, which is available for the next 6 months of this year, and the entire 12,000 tons will be available for next year. Plus, whatever additional capex that we will do now, from the IPO proceeds, that will also come on stream for next year in FY27.
Sir, previously it also mentioned about we have received orders from BHEL for HVDC transformers. So, can you slightly explain in terms of size of orders, and will these kind of orders can also come from the other OEMs in the Indian power sector?
Yeah. So this BHEL order is an initial order right now, which they have placed for 11 transformers, where the specialized winding wire is going to be used. And if you see our past also, we have a history of supplying to HVDC transformers as well as 765 kV transformers, which are, but in between there was a lull in the HVDC side. And HVDC, specialized magnet winding wires which go into the HVDC segment are the highest value addition actually, or the most profitable orders within our family of products as well. And, this is an initial order of 11 transformers. This is actually a consortium where the Bhadla-Khavda project, which is there, where for power grid, and, there are other players who have also backed, transformer manufacturers like Hitachi Energy, and BHEL has some more transformers also which will come, in the future. And we are the only ones right now in India who are qualified, the Indian supplier qualified to supply for the HVDC 400.
So last question from my end, in terms of export, we generate substantial part of our revenue from the export side. So how those opportunities are in terms of export, and rupee has depreciated, will that benefit us, and any impact because of the tariff?
Yeah. So in terms of exports, we export to, like I said, about 24 odd countries, and we have some global relationships also with some of the large power transformer. Almost 100% of our exports is actually to transformer companies where the specialized magnet wires are being exported. And we have some global relationships with the likes of GE, Hitachi, then Toshiba, etc., where we are supplying to some of their global locations as well. All of these companies, all of these locations, they are adding capacity as well. And we will definitely see some benefit of that, capacity expansion that is happening to maintain our wallet share with these customers as well. Rupee depreciation, of course, from a value addition standpoint, it does help us and we will probably see that in the coming quarters. Tariffs, okay, yeah, I'm sorry. The last question that you had was about tariffs for the US. So, today we do supply to the US market. I mean, we've been in this market for the last 10 years plus, and we have a diversified base of customers. Now, there is very little capacity of specialized magnet winding wires within the US. And if you look at the US demand, I mean, the demand is far greater than the supply position that is there. And if at all, the local manufacturer has to really step up in terms of capacity, it will still take them some time. And so then that leaves, all of the specialized magnet winding wires that are being exported to the US, whether it is from Europe or India, they are subject to this the tariff. But today the customers who are buying this material, they are paying this tariff and absorbing this tariff and passing it down to their end customer.
Sure. Thank you so much, sir.
Thank you. Next question comes from the line of Ashutosh Chaubey with ITI AMC Limited. Please go ahead.
Hi, thank you for the opportunity. My first question would be on the raw material sourcing side. How would the sourcing for KSH International would differ to any of its peers, and along with the client concentration? These two questions.
So when it comes to raw material sourcing, we would probably have the same sources when it came to copper. I mean, there are a few sources for copper available in India, and we import, of course, to have a spread between local as well as local suppliers as well as import suppliers. So in terms of that, I think we would have similar suppliers. Only the volumes that we buy would be a lot different compared to the other manufacturers of winding wires. And in terms of concentration risk with suppliers, we don't really have a concentration risk with any particular supplier. We are quite well spread also.
On the client.
No, and what was your other question you said?
On the client concentration side.
So client concentration risk, top 10 customers we have, is about 50% is the spread of business. And also, so we are not really having a very high concentration risk with any one particular customer, I would say.
Yeah, I think just Ashutosh, to add on that, the fact of the matter is that we are a B2B company with about 120 customers. So your top 10 is always going to be a meaningful component, but that doesn't necessarily introduce concentration risk because of two reasons. One is that within the top 10, they're fairly well diversified. And secondly, they've been, repeat clients of ours for years, in some cases decades. So, it's a fairly repetitive kind of relationship we have with them.
Okay. Sir, on the sourcing side, again, you mentioned that it is the volume that comes into play. So, going by that, does this scalability provide us, if you can just give me, in hindsight, some numbers to understand the quantum of volume that we place with the same set of domestic vendors and the imports that we make. Any pricing benefit that we get over there in terms of sourcing, if compared to the peers we say?
Peers are larger with certain product categories, but if you compare the top 3 or top 4, I think we would have similar benefits in terms of when we are purchasing. Maybe, I mean, I'm not sure how much different within the top 5, I think we would have similar benefits is what I would say.
The top 5
volume
models
sourcing
should be at that from volume sourcing and
Yeah.
Okay. Those are my 2 questions. Thank you.
Thank you. Next question comes from the line of Sri Narayan Ramkishore Mishra with Baroda BNP Paribas Mutual Fund. Please go ahead.
Hi, can you hear me?
Yes.
Yes, sir. So my first question was on the supply side again. So, what are the bottlenecks, for the industry that CTC supply is not able to catch up with the demand? If you can elaborate on that.
You mean to say what are the bottlenecks for the transformer manufacturer or for us?
For you.
So for us, there is no real, capacity has been a bottleneck for us. As of October 1st, we have, addressed that bottleneck because, we had started this process of setting up this new facility in Supa, and it took us about 2 years to set up this new facility. And now, we have about 12,000 tons of fresh capacity that is available. So capacity has been the biggest bottleneck. And because of the spike in demand, especially on the specialty magnet winding wire side,
Okay, so specifically there, importing of, sourcing the plant and machinery, has that been the issue, or is that, people had not set up capacities and now since the demand is there, people are now going ahead and setting up the capacity?
No.
So is it due to delay in getting machineries? Is it because of that or because of, not setting up the plant and machine, the capacities in advance that is causing this?
Well, the capacity expansion that has happened, we were slightly early in the cycle, and that's why we are sitting with the capacity that is already there on the ground. And, typically in this business, these are all SPMs that you require, and this, there is a long lead time also. It can be anything from, say, 8 months to almost a year if you really were to order new equipment. And then again, commissioning, etc., is another aspect of this. So, and then finally you also have to go through the approval process. Let's say if a new company is coming in to manufacture CTC, it's not just that they make this capex investment. They also need, to work up that value chain of starting from a medium power transformer, and then, you supply it up to the 765 kV transformer, and which could take, anything in the upwards of, say, about 5 to 7 years for them to reach that. And finally, of course, the biggest bottleneck for all these people would be the constraint would be to, even if you have capacity, is to get the end utility approval, which is like power grid, NTPC. They all want to see a track record for your product to have, been used in the field. So that also creates some issue. Even if capacity comes in, what I'm trying to say is that, it's not that it's easily available for everyone to be use it.
Mm-hmm. But since these transformer players already have relation with the end customers, will it not be easy for them to get their products approved, or they will have to follow the same process as an independent magnet winding producer will have to do?
Oh, no. Even a transformer manufacturer, one is, of course, the complexity of the product also is there, and which is again, there are different complexities when you're manufacturing these products. But for a transformer manufacturer, he would also have to go through the same steps of getting approved by the end utility as well, So I don't think it is any different for whether a transformer manufacturer is manufacturing it or if we are manufacturing it or any new player is manufacturing it.
Yeah, I think just one clarification that ultimately a transformer manufacturer supplying is only able to select a vendor such as us or anyone else if the vendor or us is already pre-qualified and appears on the sub-vendor list of the utility companies. So they cannot go and institute any other vendor unless it's pre-approved with the utility.
Right. Okay. And if they were to resort to importing, so how easy is to switch to imports and for these manufacturers to cater to their demand, because they are also sitting on order books, but this shortage of CTC and boostings is what constraining them. So if I were to import these and supply, so how easy or difficult would it be?
Yeah, well, we know that there is some imports happening, but that's at a much higher, cost right now. That's because the capacity was not available. And we don't see this trend continuing because, now that capacities are available, we would be in a position to service all the local customers as well,
So what would be the gap there?
In terms of the quantity being imported?
No, pricing.
Pricing, in this product, if you just on a like-to-like basis, there is a 10% duty element which is applicable on any import. Now you add that 10% on the copper price as well, which is roughly, you can take 1,000 rupees a kg is just the LME element of it. Then it becomes quite a substantial gap.
Okay. So, secondly, this copper prices, US is talking a lot because of duties, and elsewhere we are facing shortage. So, for your order book for next year or 18 months, how do you see your raw material sourcing? I know pricing is a pass through, but in terms of having sufficient inventory levels to execute your order book, how are you doing that?
So for us, we have tied up, all our copper suppliers are long-term suppliers, and we've been working with them either right from inception or, at least a vintage of at least, 5 to 10 years as well. And, if you see that all the copper rod producers also, like Hindalco or now Adani, Kutch Copper, which has come in, or Vedanta, HCL, etc., they're all adding capacity as well. So, really, if there is any problem at their end where they're not able to source the concentrate to make the rod, then it would be actually a India-wide problem. It's not just a industry-wide problem. But otherwise, we don't see any challenges. Typically from order to supply is typically a 2-day cycle. Where from the time we order the raw material, by the time it reaches us, it takes only about 2 days.
So, how many days of raw material inventory you are maintaining currently?
Around 15 to 20.
Around 15 to 20 days. Yeah.
Okay. Great. And you earlier mentioned this is regarding EBITDA per ton. That is purely because of high, specialized binding wires contribution rising up. So I wanted to know what was it in last year, H1FY25. How much contribution was from specialized binding wires, which is 78% now, I think you said earlier.
It was around 75%. Yeah.
So just by 3 percentage point increase, EBITDA has increased from, I think 41,000 to 65,000.
46,000, 46. Not just the quantity increase, but like it was pointed out, the mix of the CTC that we've sold to higher transformers has actually pushed the EBITDA per ton up.
So export, in terms of volume has gone up, and then if you see within the transformer segment also, we are more on the upper end of the transformers. Like say, if you say for example 765 kV, that would obviously have a higher value addition component because of the complexity of the job as well. It's not just that we are getting a higher price. There is a complexity aspect also.
Okay. Okay. So what would be the salience of this category of orders in the order book?
What would be the?
Salience, I mean, the total contribution of these category of orders. How much would these orders contribute to total order book?
So, I mean, just to let you know that we don't really work on an order book. Normally what we have is a repeat, like we have a contract with the customer where they book our capacity for the year or maybe slightly higher than that. And typically these are all repeat, contracts that we get. 80 to 85% of our business is normally always repeat. The same customers will be repeated. It's gone as high as 90% also. And generally we keep some, capacity available for any rush orders or any new customer development that we are doing, So order book as such.
I understand, sir, but given that the demand supply mismatch, it is well understood that you will be fully booked up by the OEMs for next, at least I think, 1 or 2 years.
Yeah.
So in that, how much is this category of orders? That's what I am trying to understand.
For the specialized?
Yes.
Normally, what is one? A third of the CTC? 10 now.
Yeah, so I think if you look at the large power transformers out of our CTC, today about 1/3 of our CTC volume is going to the largest class of transformers. That's up from, single digits even 2 years ago.
Yeah. Mm-hmm. Okay. So 1/3 is going to this category. Is that correct? Okay.
Yeah.
1/3 of CTC.
Yeah. Okay. Thank you. Thank you so much.
So.
Thank you. Next question comes from the line of Nilesh Jain with Astute Investment Management Private Limited. Please go ahead.
Hi. Congratulations on great numbers. My first question is on, I want to understand, you can probably talk at the gross margin or EBITDA per ton. What will be the difference for your two products, that is standardized and specialized copper winding wire?
Generally it's 3:1, So EBITDA per ton.
Okay. Second question was, obviously your EBITDA per ton has improved from if I look at your historical numbers in FY23 from 28,000 per ton, almost it has moved to 65,000. So the large reason would be because of your increase in specialized product, or it could have some impact because of the increase in copper prices as well.
No, copper prices has got no role to play in the EBITDA per ton. But, once again, just to be clear, that what's contributing to the increase in EBITDA per ton is, of course, the product mix that is there. That is a higher concentration towards, the larger kV segments, where the complexity of jobs are, more, but also at the same time, the profitability is higher on these kind of products that we manufacture. And the third contributing factor is the exports, where, we have, exports are generally better margins than the local, market that we are servicing. And then, of course, you have your volume, which is adding to the operational efficiency as well, where the fixed cost absorption is much better.
Okay. So we expect then this EBITDA per ton number to at least sustain in this financial year and going forward, given you have getting high orders from, high voltage transformers.
Yeah, our endeavor is, of course, to, maintain these kind of EBITDA per ton figures, now.
Okay. My third question is on the new plant, which has commissioned. I wanted to understand, would it also require all the approvals which have been there for your other plants? If yes, then how long does it take generally?
Yes, so we are already in that process, and some of the customer approvals we've already got, and of course we would we would basically use the new plant for newer customers, where, there is a capacity constraint for them. But obviously the more complex jobs that we are doing, we would continue in our existing plants, So that's how we would be utilizing the new plant capacity.
Okay. And last question is, do we face any competition from the Chinese player in any of our products, obviously for the export market?
So, once upon a time, the Chinese were quite predominantly there in the US market. But as of right now, I mean, that's absolutely, the US market is something that the Chinese vacated, post-COVID. And that's where, we were able to really, focus on and increase the volumes as well. And, it's the same situation we've seen in the Europe, where this China plus one, or not China plus one, but, having another alternate source as a supplier. And we've been beneficiaries of that in the other export markets as well. Of course, in some geographies where, like say in Southeast Asia, like Indonesia, etc., we find it difficult to compete because of certain FTAs that the Chinese manufacturers are having, with these countries. But Europe, Middle East, then in Japan, we have a pretty level playing field, and we are as competitive as the Chinese on a like-to-like basis, So that way, we have not seen anything in the US, etc.
Okay, sir. Thank you, and I wish you all the best.
Thank you.
Thank you. Next question comes from the line of Nishant Sharma with Nuvama Wealth PCG Research. Please go ahead.
Thank you for the opportunity, and many congratulations for maiden IPO and the first successful quarterly update. Hope to see this momentum continues as the demand momentum is very strong, and now we have the capacities also available with us. So my first question would be, sir, around CTC capacity. What is the current CTC capacity, and going forward with the new addition of 12,000 tons, what would be the capacity of CTC?
We generally don't report only product capacity. I mean, we don't break it up. But, if you see our specialized versus standard, I think we are giving that in the investor presentations,
Yeah, I think long term, we expect it sort of to be a 60-40 mix with special.
Okay, great, sir. Secondly, sir, while working capital days, if you can elaborate a little bit more in terms of measures and target that we are looking for working capital days, because the major difference is mainly on the payable side vis-a-vis competition, and that's significantly different from competition. So more of investors are concerned around working capital days and how do we like to tackle that scenario going forward, and what's our internal assessment where it can stand.
Right, correct. So, rightly pointed out by you, our payable days are much higher as compared to the peers. And till now, what we were doing is we were, purchasing copper basis 100% advance. But as our capacity is going up, we are, initiating steps to ensure that we purchase copper more and more on credit than on advance, like is done by our peers. Now, that itself will reduce our increase our payable days and reduce our working capital days going forward.
Okay. And one more question related to return ratios, sir. While we have a best-in-class EBITDA margins or EBITDA per ton, our return ratios, especially return on capital employed, seems to be similar or a little bit lower than the competition. Any sense how are we looking to improve on this number going forward? I'm talking purely on FY25 basis. While near-term IPO proceeds may have some impact, but X of that, how are we looking to improve on those return ratios?
Right. So if you're talking about the return on capital employed, this is somewhat linked to my earlier question that you asked. So what happens is when we purchase copper on against advance, you end up using the working capital limits much higher as compared to the peers. So because peers are using the supply line of credit, their payables are much higher and working capital utilization lower. So the loan outstanding tends to be lower in the short-term loan category. That's why ROCE, if you see, will be almost equivalent or little lower than the peers. Having said that, there's always a trade-off where if they are finance, if your cost bank finance is better as compared to the supply, you always tend to use the bank finance more than the supplier finance. But that gets reflected in the ROE. If you see the return on equity, which is the ultimate return that goes to the investors, our returns are much better than the peers. So as we go ahead and we use more supply line of finance, our working capital utilizations are expected to stabilize in line with what the peers have, and so we expect the ROCE also to that extent get impacted because of that.
Okay, thank you very much. And the last question related to the announcement on the management change in the management level. If you can explain a little bit and what could be the implication of that?
So Rohit Hegde, who's the other joint managing director, who's my brother, he is going to take up a more active role in some of the other group companies as a whole-time director. So that's the only change. He'll continue being on the board as a non-executive director, but not as an executive director. Otherwise, there's no real change.
Okay. Thank you. Thank you for the clarification. Many congratulations on this. Thank you.
Thank you.
Thank you. Next question comes from the line of Bhavin Chheda with Enam Holdings. Please go ahead.
Yeah, good morning, sir. Overall, very good results and very good presentation giving detailed explanation on everything. So few questions. First, as I think on the call you mentioned that in the longer term, the specialized winding wire capacity will be 60% of total capacity. I wanted to understand whether the capacities are fungible.
No, so when you look at, to give a short answer, no, it's not fungible. Specialized winding wire, within that specialized winding wire, it's slightly fungible because some processes are common. But if you look at like standard versus specialized, you need a specific set of machinery itself, and which is quite different.
And the new Supa facility will be entirely specialized, or is there a mix of standard capacity there also?
No, there's a mix of both standard and specialized. Of the 30,000 tons of capacity that we are adding, there will be a mix of specialized as well as standard.
And this first 12,000 ton, what has been commissioned, is with what type of capacity?
Again, both. It's a mix of both.
Okay. Yeah. Okay. And sir, in the presentation, you have very well explained that we should look on EBITDA per ton despite copper prices being so volatile. So does the standard wire also follow a similar formula with your long-term clients, or standard wire business is more a percentage business than EBITDA per ton business?
No, so the standard wire also follows the same, when it comes to the B2B side of it, and we are in a B2B industry where copper is a complete pass-through, and there is a value addition that we agree with the customer, and that value addition is independent of the copper price. So, and I think in the
entire all the volume, entire business will follow a similar model.
Correct.
And there is no percentage. And you had also mentioned that the difference between specialized and standard is 3:1 on EBITDA per ton, right?
Yeah, that's right. And because of the complexity of manufacturing processes, that's why it is there.
And since my last question, the BHEL has recently placed you order for this HVDC transformer, which has the highest value added in your overall portfolio. And I think it will go on for next 12-15 months, which means that the current EBITDA per ton would be maintained and improved going forward, because obviously the rupee depreciation will also at some point would help in your export business. So we should expect a gradual improvement in EBITDA per ton?
So when it comes to, this EBITDA per ton for the HVDC orders, see this, even though this is an order, it doesn't really move the needle too much from an overall, capacity that we have. But, why it's important for us to mention is that going forward, there are, more HVDC, HVDC is going to be a growing segment, and a lot more, consortium members are getting orders, and, that's something that we would like to, highlight, that we are the only Indian supplier for this HVDC segment,
Yeah. Thanks a lot.
Yeah, thank you.
Thank you. Ladies and gentlemen, due to time constraints, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
Yeah, so I would like to thank you on behalf of KSH International for attending this call, and I hope we've given you whatever information we could, and we've tried to include it in the investor presentation, and we look forward to the next quarter as well. Thank you. Thank you very much.
And for those that we were unfortunately unable to reach for questions, please reach out to us and we'd be happy to answer any questions. Thank you.
Thank you. On behalf of KSH International Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.